Well, hello there. Welcome to Ask the Experts. This is the broadcast where the editors of MoneyWatch.com answer your financial questions. I'm joined by the editor-in-chief, Eric Schoenberg.
Nice to be here, Jill.
Who has miraculously made it here. It took you as long to get from New Jersey to New York as it would have taken you to get, I think, to Europe. Pretty much.
That's right. Today, I am not a living advertisement for New Jersey Transit.
All right. And he'll get his rant on that later. We are also joined by special guest star Allan Roth. Hello, Allan.
Hi, Jill. Thanks for having me.
Great to have you here. So let me give you a little of Allan's bio. Roland, pop up this screen here so we can put up. Allan is a blogger for MoneyWatch.com, the irrational investor. And here's a little of his background. He's the founder of Wealth Logic, an hourly-based financial planning and investment advisory firm that advises clients with portfolios ranging from $10,000 to $50 million. You got a client with $50 million bucks?
I do.
That's
Be
when
nice to him.
I was going to say that's when you wish you were AUM.
I'm nice to everybody.
Give me 1% on that $50 million. Okay. He's also an author of How a Second Grader Beats Wall Street. He teaches behavioral finance at the University of Denver. He's an adjunct faculty member at Colorado College in Colorado Springs, Colorado. And he's just an all-around nice guy.
Well, thank you.
That's pretty damn good, right?
Yeah, and I'm flying back to Colorado Springs tonight, and it'll be faster than your commute here.
Most
Probably.
likely. So we've got tons of questions today. I just want to remind everybody, if you have a financial question, you can shoot us an email, asktheexperts@moneywatch.com. You can also go on to moneywatch.com and hop into our live chat, which I finally know how to moderate. It only took a few times.
Well, technology is complicated, but I'm glad you got it down.
Oy vey, is it complicated. Okay, you ready? Here we go. Let's start with this question from Aubrey. You're going to like this one, Eric. I invest 5% of my income into a 401k. My employer matches it with another 5%. I want to do more. This is my first job out of college. Hooray for you.
Yeah.
Right? Putting the money away. And he wants to put his money to work. I'm young, willing to make some riskier investments. Where should I invest my money? Or is the market so bad that I should pile more money into my 401k for safekeeping? I think what he's actually asking is Aubrey a man or a woman's name? I keep
Could
saying
be
man.
either.
Those sexually ambiguous names are hard for me. Okay. So 401k, there's obviously a safe part of it. There's also a riskier part. But it's the first job. Aubrey put more money in, not put as much money in, risk, no risk? What do you think?
I would put more money in. 401k is kind of hard to beat. You'll get a tax break on it. And this company match sounds terrific. It's 100% on at least 5%. If it's 100% going up higher, so you put every dollar you put in gets 100% return instantly. How are you going to beat that, going out and taking more risk? And Aubrey's right. Young as he or she is. Yeah.
Aubrey, you're a nice person. We have no idea who you are.
Well, certainly got his or her head on right about how to get ahead in this. Look, it's going to take a lot of money to make yourself safe and give yourself peace of mind and pay for retirement, which may be a long way off, and you can do better than 5%.
Hey, Allan, do you get any folks who are like really young people who come in for hourly advice?
Absolutely.
And you tell them to just pile on the risk, or what do you think?
I tell them to pick an asset allocation and stick to it. And the sticking to it is even more important than picking it right in the first place, because it means you have to rebalance. And Aubrey is doing something that I can't teach. I mean, people are either spenders or savers, and I don't know what actually creates this, but doing the right thing by stashing away cash.
Wait a second. Do you think people are hardwired that way? Or is it like, okay, your parents were totally controlling with money and then you become a spendthrift? What do you think about that?
I'm fascinated with it, and there's so little research. I'll have clients that'll have one child that stashes away every penny they can, and the other child is in credit card debt, losing their home, etc. So I'm really not sure what makes somebody a spender or a saver.
Well, it so happens the behavioral finance expert Brad Barber was in the offices the other day, and he's doing research on this very topic, and the preliminary results seem to indicate that you are hardwired to be a saver or a spender.
And so what do you do if you're hardwired the wrong way? Yeah, I mean, that's the killer, isn't it?
You have to marry well then.
No, it's like, like when they say, like, well, you're just lucky you've got good genes, so you're going to be skinny. Well, what about the person who's got the bad genes? Like, it's that much harder. So then I imagine, Allan, that's really when you need the plan and you need the discipline. You need someone to also help you stick to your plan.
People that don't save are typically very optimistic. Things will take care of themselves. And I try to give them bad news. And I remind them that they may be asking if you want your meal supersized pretty soon.
Oh, dear. Well, I think that's interesting. I'll be excited to see that research when it comes out. So we have Jay asking, in your estimation, is gold only a, quote, chicken little investment? Or is it prudent to have 5 to 10% of your nest egg in it? Alan, what do you think about gold?
I am a believer in precious metals and mining as a diversification strategy, not buying it because it's hot. I've made the mistake of buying gold in the last gold rush in 1980, and I've earned a 2.3% annualized return, less than the 3.5% inflation. So you can buy gold for the right reasons, but buying gold when it's hot and everyone's predicting it's going to 3,000 by the end of the year is not a good reason to do it. I've made that mistake.
Eric, what do you think?
Well, I was going to put the question to you, Jill. You've been a gold trader. What do you think about the yellow metal?
I love gold, but I agree with Alan. You don't buy it because it's up. But I call it the fear trade, which is it's a little insurance policy. I would not have 10%. I would actually keep a precious metals position to less than 5% of a portfolio. And I would say it's a nice little insurance policy against the world really taking a bad turn in one way or the other. Wild, rampant inflation, another horrible financial crisis and event. That's great. But over time, it's not one of those asset classes that is dependable. There's no dividends. There's no, there's nothing to really analyze. I guess you could say, well, there's X amount of gold that's in the ground, and there's all these ETFs that are forcing gold to rise in price. But generally speaking, I like it as the fear trade, a little piece.
Yeah. I don't think I'm going to be going to the grocery store and buying Cheerios with gold.
No. Although, like my grandmother was like, oh, my gold got me out of Hungary. It saved my life. So she was a big believer in having lots of jewelry as a result. I like that part of it.
And I'm selling precious metals and mining because I'm rebalancing.
Right. Well, that's the other thing. It's so great if you have a core position, and if you are rebalancing, it forces you to sell when it's up. So here's a great story. I ran into somebody at the CBS Broadcast Center, and I knew that he had purchased a stock. I actually knew we were talking about Goldman Sachs, and we had both talked about it. And he said to me, well, what do you think? I bought a bunch at 135. And I said, fantastic. So I went to see him yesterday, and I said, well, what'd you do with your Goldman? He goes, well, I'm waiting. And I said, what are you waiting for? He says, to go higher. I said, so you already made all this money. It was just a flippant, off the cuff kind of trade. It was just your kind of quote unquote, quote, fun money. And it did. And what are you waiting for? And the answer is he's just waiting for it to either go higher or much lower. Mm-hmm. Mm-hmm. So you got to have a plan, right?
Absolutely. And there's a second lesson there. I have my own little fund portfolio, and I'm more likely to tell you about my winner's Priceline than I am my loser's United Airlines.
Right, exactly. Well, that's like the gamblers, right? Steve wants to know, I'm largely in cash at this time. I have a few $100,000. Few $100,000, like it's $2. Oh, I have a few $100,000 that's earning little interest in savings. How should this money be invested for retirement? I'm in my early 50s, Eric. Couple $100,000 floating around. We don't know why or when, but want to take a stab?
I think it's hard to keep your money in cash these days. You're not getting paid for it. On the other hand, everything looks pretty risky. But I think that you have to take calculated risk, and you have to diversify and not put all your money in any one asset class. Cash is a bet. First of all, on your ability to time the market to get back in, which is not really a good bet. Allan has had some, and Allan, when it comes to cash, has some very good ideas about places to put cash where you get a better return than the 0.1% you can get on a money market fund. Why don't you talk? Let me toss to you on that.
Probably the best place is a column I wrote, Where to Stash Your Cash. And Ally Bank, which was the old GMAC bank, and a lesson to always stay below FDIC limits. But they have a great 5-year CD that only has a 60-day penalty. So even, I believe it's paying 2.44% right now. So even after the 60-day penalty, you're still earning about 2% if you take it out within the first year. So that's a way of getting a little extra yield and using a product kind of for off-label purposes.
How are they able to do that deal?
I don't know the
answer to that. I'm
going to
tell you why. Because they are basically have the explicit government guarantee now And it's like it's completely ridiculous, actually. Like I agree, it's an awesome deal, and I would take advantage of it. But like taking 2 steps back, that deal is so good because Uncle Sam owns a piece of GMAC, which they then relabeled Ally Bank, and then did all their public radio underwriting around it, which is great. But like, are you kidding me? We're subsidizing those good rates.
Yeah, we are, and they absolutely do know about it. I interviewed them; they know about it. And there's one other little wrinkle because they don't allow partial early withdrawals. If you're going to stash, let's say, $100,000, open up 10 $10,000 CDs so that if you have to take any money out, you can take them out in 10,000 increments.
Right.
And they're aware of that as well.
They're playing the game. It's okay. Megan, by the way, is pointing out to us that we can do where to stash your cash link, which is, and by the way, I used that article, that blog post, as a TV segment, which they loved. Highly teasable. We loved it. And I did give you props.
I saw that, so thank you.
Next question, gentlemen. John is a CPA. He has got this question for us. By the way, I never trust CPAs asking these kinds of questions.
I'm a CPA, by the way.
Exactly my point. In your opinion, when are variable annuities appropriate for clients in the age 50-plus club? I'm going to bet right now that John is selling variable annuities to his clients. Just saying. What do you think about that, boss?
When it works is never, never, never.
Okay, let me just rephrase that. What Allan is saying is variable annuities don't work.
It's an indirect investment.
Nice. Oh, Megan, very nice on that sound effect. Fantastic.
You're going to be in the market, only you're going to be paying the insurance agent a nice commission, and you're going to be paying the insurance company. You know, you can guarantee a house for loss, but you can't guarantee that the house is going to go down in value. And essentially trying to get guarantees on your investments just doesn't work.
Right.
It's great for the retirement of the agent selling them.
Ooh. Eric, do you want to add? You want to pop in on that?
Other than that, I don't have any strong feelings.
Well, I think I want to use that line, but let me ask you a question, because a number of variable annuities now come with a relatively new feature which protects you on the downside, just to be explicit about your answer, or guarantees you a certain income after you retire, no matter what happens in the market, considering the amount of uncertainty out there. And we have John, I believe it was, who's so nervous about the market, he's staying in cash even though he's 50. So if it gives you that peace of mind, isn't a variable annuity worth it?
Well, not from an economic standpoint. It might say, we'll guarantee you a 7% return, but that return isn't in cash. That return is either in a death guarantee or a living guarantee, an annuitization. And I've looked at some of the annuitization, and it's roughly at about 52 cents on the dollar of what you could buy on the open market of an annuitization.
And if we also, I mean, just not to go too deep diving on the variable annuity front, but the time when variable annuities did work were when tax rates were way higher, when capital gains and dividends were taxed at a much higher rate. And even then it was a stretch, wasn't it?
Well, yeah, because it was a short term it worked because you got to defer the annuities. But when you used the money, instead of paying long-term capital gains, you paid ordinary income. Yeah. So in the long run, it wasn't even tax efficient then.
So, by the way, the best thing to do if someone's trying to sell you an annuity, now listen up here, guys. Someone tries to sell you a variable annuity. You ask very bluntly, like this very uncomfortable question. You say, how much do you get paid if I buy this? Just ask that question. And then say to your broker, advisor, CPA, whoever, say, well, what would it cost me to invest in something like this outside of an annuity without that wrapper on it?
And they'll hear there is no such thing, and they'll hand you a 1-page thick or 1-inch thick disclosure document and ask you to sign a form saying that you've read everything and understand it all. Anytime somebody asks you to sign something saying you've read an inch-thick document, you can be sure the attorneys and the actuaries didn't write it to protect you.
That's true. And are you also an enemy of the fixed annuity, or do you feel okay about the fixed annuity?
I think an immediate annuity, I think there are times when a no-load immediate annuity can make sense. But
Let's just interrupt for a second to explain what an immediate annuity is compared to a deferred annuity.
It might be I invest $100,000 and it is going to pay me, let's say, $5,000 a year for the rest of my life.
A guaranteed income stream as long as the insurance company doesn't go broke.
Correct.
Right.
Now, people tend to think, well, $5,000 on $100,000, that's 5%. But it's not, because you're getting your own principal back.
Right.
But I'm a believer in insurance, and you are getting longevity insurance. So if you're over 70 years old, there can be circumstances where you're providing some insurance that you won't outlive your money by pooling with a group of other people 70 years old.
Yeah, and also, I mean, one of the reasons I think that the fixed nature of an annuity or a stream of income works is that, we're human beings, and not every human being was really hardwired to be able to manage a big chunk of money. I just got this question. I did a retirement seminar for the folks at CBS News, and one of the people there who is part of an old pension system said lump sum or annuitization, right? Months, should I take this big lump sum? I could get $500,000 at once, or I can get a smaller monthly check for life. And I said, well, what kind of person are you? And when I talked to him further, it was really like, he's like, doesn't want the responsibility of having to invest the money. He's okay with saying, maybe I won't make as much, but I like this guarantee. I like this monthly check. And that seems okay to me.
There are a number of studies that show that if you get an immediate annuity, a stream of income like that, and have it as part of your portfolio in retirement, it actually can give you a better return at a much lower risk. And another question I would ask, too, quite apart from your personality, is not what's your personality at 65 when you make this decision, but what's your personality going to be at 85?
Right.
And are you going to be making good investment decisions? Do you want to be managing a lump sum and making sure it lasts the rest of your life when you're that old?
But Vanguard has some managed payout funds that I think are very interesting. And don't forget the risk that you take. If I'm 70 years old and I buy that $5,000 a year income stream, and I don't know that we are going into a bond bubble, but I think it's a real possibility.
Sure.
And if we hit hyperinflation, then each year that $5,000 payment becomes worth less and less and less.
Right. Well, that's actually to Eric's argument that doing it with a portion of your money is not a bad idea. That's not a bad. Okay. We've got one from RJ. My wife and I are considering investing in the development of a number of small rental homes. The intent is to have these homes built on several rural properties that we own and then rent them out to people, seniors from larger cities who are selling their homes and want to move to a rural area. So is this a reasonable strategy for creating one of the streams of our retirement income? Asks RJ. What do you think?
I think that the stock market is very efficient. But when it comes to looking at individual pieces of real estate, somebody that knows what they're doing can actually create value. Now, in this, where there's so much in the way of vacancies, I would question whether or not you want to build something versus buy it on the cheap, even in the foreclosure market.
Right.
That might be the better way to go.
And are you really all jazzed up about being a landlord?
I think that's a really good question that you have to ask yourself about if there's so much excess inventory in housing right now, why would you add to it by building?
Yeah.
And you've got to be able to take that call at 3 o'clock in the morning when the water heater bursts.
You remember how Fred Mertz used to run downstairs to Ricky and Lucy's apartment? Remember, the Mertzes were the landlords. It didn't seem like they were very happy. So I'd rather be Ricky and Lucy than be Fred and Ethel in that case.
You're not that old, Jill. How do you remember that?
I love Lucy. And so does Chris, who is probably the youngest member of our staff. So,
Right.
All right, here we go. One from Karen. My husband's 59, just retired. In January, he'll receive his deferred income check for about $75,000. What's the best way to invest some of that money so that we'll have additional income until he reaches 65 and starts receiving Social Security? So they're concerned about the gap, right, between 59 and 65. Karen is 61. She can qualify for Social Security in 2011 at age 62. Should I do this or wait until 65? Eric, you want to take a couple of those or part of that, or what do you want to do?
I'll put that back to you guys, you real experts. There definitely is a right answer to when to take Social Security, or at least a series of right answers, depending on your situation. So let me put it back to you.
I say that absolutely not. If she doesn't have to take it at 62, never, ever, ever take it early. Unless you are, God forbid, you're really sick. And your life expectancy is pretty bad, and you've got stage 4 cancer, and yes, take it at 62. Go get your money. But Alan, any reason to take it early?
Totally agree with you. If you're in good health, you're getting more longevity insurance by waiting. It's kind of a much better deal than buying that immediate annuity.
That's
and
right.
if you have taken it early, by the way, and you still have the money, the government gives you a do-over. It allows you to pay the money back. And if you do the math on that, let's say you've collected $40,000, you pay it back, and the next month start Social Security again, you get roughly twice the additional cash flow as you could get dollar for dollar in that immediate annuity.
So how do you do that? I mean, in other words, you took Social Security at 62. You said, I shouldn't have done this. What's the procedure?
You contact Social Security. You find
that
out.
must be fun. That'd be a
I've
great
had clients that have
experience.
done it. It's not fun, but you
Let
can
me
do
go
it.
renew my license while I'm at it.
They calculate how much you've received. You write them a check, give them the money back.
Lump sum.
No interest.
Oh, very
And-
nice. That's a good trade there, right?
Yes, it is. It is.
And a lot of times people ask me, at 62, how about if I take it now and then 5 years later I'll pay it back? And my answer is I wouldn't do it now, and that's because the Social Security trustees can unilaterally end that.
Oh,
And
right.
You can't earn much on your money risk-free now anyway, so it's not worth the trade.
Interesting. And also, just want to remind people, if you are the spouse, right, and let's say I'm working and my spouse is dependent on my Social Security benefits, right, gets half of mine. If I elect to receive that money at 62, and this generally happens, and it really screws men who are working, it really screws the potential surviving wife, because now I'm going to get a reduced benefit forever. And if I drop dead, my wife lives another 30 years, her benefit is permanently reduced.
Yes.
It's terrible. It's just a bad deal. So don't do that. All right, second part of the question from Karen. What should we do with her husband's $75,000 to get a little extra money for the next 6 years? What do you want to do?
Don't chase income. In other words, live off of the $75,000. Invest it in something that is low risk. Probably returning, even CDs, you can still earn 3.49 at Pentagon Federal Credit Union on a 7-year CD. But people are making the mistake of buying lower credit quality, longer duration, the same bonds that just got killed only 2 years ago.
They forget.
Yes. Investors have very short memories, not efficient learners.
Well, that's the human being darn thing
Yes.
again. Eric, here's one from Jim. He recently lost his job, and wants to know what to do with the money that was in his 401k plan administered by Fidelity. He's fully vested. Should he leave his money with Fidelity? Should he move it to maybe Edward Jones, who administers his wife's retirement plan, where I personally know the local representative, where I'm sure that personal local representative may have picked up the phone and said, can I help you? What should our Jim do?
I don't think our Jim should be swayed by his friendship with the man from Edward Jones. I mean, I'm sure he's a very nice guy. That's how you get ahead in the brokerage business, by being a very nice guy. But it's going to be a lot more expensive to invest through a brokerage like that than it is to keep it at Fidelity. And Fidelity has a lot of tools that will help you, if you're a self-starter, Jim, to make good decisions.
Yeah, and I think that that it's also like you kind of know the system there, and you can just roll it over. You have an IRA rollover with one caveat, Alan. If he really does want financial help and he does want assistance and he does have a relationship with this guy, should he consider hiring someone?
Most of the financial advice that I see from advisors are fairly self-serving.
You're kidding me.
I am not kidding.
Eric,
I know
can
that
you
shocks
believe
you.
that?
I'm gonna have to query this.
This is crazy. Gambling? I'm shocked there's gambling going on here.
You cannot have an expensive, good portfolio. You can have you can be in a low-cost, all emerging market portfolio, which might not be good, but you've got to keep costs low. You can do that in a Fidelity platform, in a Vanguard platform, Schwab, others. A full-service brokerage, you can't do it.
But you might get a nice round of golf out of it.
You might get
And a
tickets
couple
to a
good-
game.
Right.
Not on $75,000. I mean, it depends on how much money you have. The tickets are based on the dollar volume.
Oh,
Yes,
right.
yes,
There is that.
right.
Okay. Okay. I just have one here from Al who came in. So this is interesting. This guy wants to know what is the highest yield? What is the highest yield with the greatest risk, and what is the safe bet? In other words, he's really behind on his retirement contribution. So he kind of wants to know the parameters. Like at the end of the day, the safe bet's going to get me a couple percent, right?
Yep, about that.
And what's the highest yield with the greatest risk in terms of, let's first start with the highest yield with the greatest risk in the bond market.
Well, I mean, you can buy a junk bond fund, otherwise known as a high yield bond fund, yielding 7-8%. I suppose you can find somebody and buy a non-performing, mortgage portfolio, which if it performs will make you a lot of money. But that is, ultra risk taking.
And what about having a portfolio of dividend-paying stocks and, with, let's say, 50-50? What would you, when you look at your retirement scenarios, you look at a guy who's, say, 50 years old, I'm going to retire in 15, 20 years. I've got a balanced portfolio of half stocks, half bonds. It's good stuff. It's well diversified. I'm going to work with you, Allan. What's the number that you really want people to keep in mind for retirement planning purposes in terms of return?
Well, it depends on the portfolio, but I think somebody that has a very efficient 50% portfolio and can avoid those fees and can avoid those emotional mistakes, which advisors typically show, by the way, getting into the market in good times, selling out in bad times, one can get about a 4.5% drawdown, 4% drawdown, on their portfolio. But
so let me just explain that. So 4% drawdown, meaning if I've got $1 million and I can count on getting 40 grand a year.
40 grand a year, and if there's 3% inflation, 4120, the second year, increasing with inflation. But the typical investor can only get about 2.5%, 25 grand, and that's the cost of the fees and the cost of the market timing.
Wow. And what about if you're doing like retirement calculators? Because, we all have them on our retirement plan websites, right? And it says, what rate of return do you want to put in? Do you want to put 4% rate of return in? Or in terms of like if I'm in accumulation phase, I'm still working, I'm putting money away, should I use 4%, 5%, 6%? Remember in the 90s, I used 12%.
I do. Yes, I remember that.
I
do all my modeling in real terms. So I factor out inflation. And I basically say that before fees, equities, this is a guess, don't ask me to support this.
No, we don't want to.
Will earn 5% above inflation in the long run.
So that would be this year 6%, right? Because inflation's at 1%.
Yeah.
Okay.
And fixed income, high quality fixed income, 2%. So therefore, a 50-50 portfolio will earn about 3.5% above inflation. And that's how I do my modeling. Monte Carlo simulation has taken in a lot of criticism in 2008, but it wasn't the model. It was the assumptions that, stocks will earn 12%. I'll know when to get out, so I can add another 2% because I'm a professional advisor. The standard deviation is 10%, meaning that in any given year, the portfolio will never vary by more than 20%.
That would never happen.
No. But it wasn't the modeling. It was those, garbage in, garbage out.
Jill, you raise an important question. A lot of those retirement calculators you see online still have those old assumptions built into them. 8% returned on a portfolio that's 60-40 stocks and bonds. That implies stocks will return 12%.
Yeah. And you know what else I love? I love when they put in, there's a number where they sometimes will plug in your date of death. And it seems quite young to me all of a sudden as my parents are getting older, but sometimes they're 85. So I'm all about putting 95 in there. Like pretend that everything goes well and you live a little bit longer than you think because your money could run out.
But the penalty for running out of money is a lot higher than the penalty of outliving your money.
Yes, absolutely. Absolutely. So I think you really do have to check those calculators, see what the inputs are. And, also you have to readjust, as you say. Like part of this game is not just watching it in the good times. It's really being patient enough and diligent enough to watch your money on some regular basis. Now, what do you like? Do it yourself, guys. Not going to hire you, but on what interval do you think people should be rebalancing and really checking in with their money?
It's not a matter of time. It's a matter of variation from target. So that person that's going to be 50% in equities, I think should rebalance if they're 5 percentage points above or below that. So if it goes up to 55%, it's time to sell some equities. If it goes down to 45%, it's time to buy. Now, you've got to remember when it goes down, the media is going to be saying there's a Great Depression ahead, get out, Mad money is going to be telling you to get out of the market, et cetera, and you've got to be able to ignore all that.
Well, what about so in other words, you do it based on percent of goal, kind of, but what about the idea of just saying quarterly, I'm going to rebalance no matter what?
I think that's fine. I think rebalancing more often doesn't buy you a whole lot more, a lot of the research shows.
Because I'm worried, like if you're talking to just somebody out there who wants to manage his or her money, that the idea of like, oh, I got to track when it's 5% up or down. I'm not going to do it. Like, I'm a realist, after dealing with clients for so long, people just don't do the things they say they're going to do. I'm going to go to the gym 5 times a week. Really? I don't think so. So in that case, can we give them like a little bit of a ball 4 and let them take their base and do it quarterly?
Yeah, I think it's fine to do that.
Okay. What do you do, Eric? You check it every day, you animal?
Yeah, I'm not a very good example. I check it far too often.
You do?
Far too often for my own good.
Do you find yourself doing
Me too.
something wacky, like when you do check it, or do you hold back from acting?
Yeah, I usually hold back from acting because I've listened to people like you and Allan, but I don't say it doesn't do a lot for my peace of mind. I think what the
So you do like to just drive yourself crazy.
I would say one thing that people can do, which is kind of based in reality and the way people behave, is pick one day of the year in which you promise yourself you're going to do it. It's your birthday. It's Valentine's Day. It's
Valentine's
Flag
Day
Day.
Do with my money? Come on.
I don't know.
Flag
It's someday
Day.
you won't
Flag Day's
forget.
my birthday.
Let's say Flag Day's all right.
Groundhog Day.
Oh,
and
perfect.
Just one day. You're going to do it. You're going to force yourself to rebalance. And if you don't look at your portfolio from the previous Groundhog Day, you're probably going to be better off, actually.
See that? You look at it all the time.
Yeah, I'm guilty as charged. I look at the market.
But you have to look at it. You're
No,
in
I
the
don't.
business.
I would be thrilled if a client called and said, "What's the market doing today?" And I said, "I don't know."
Really?
And regret bias shows that we get twice as much pain from a dollar lost as we do pleasure from a dollar gain.
I totally get that. That's me.
Yeah.
I hate
So,
losing.
By looking at the market 10 times a day, I'm causing myself twice the amount of pain. It's a destructive habit like any other destructive habit.
Well, why don't you start drinking? Because it's a change the habit.
I did.
Now, there you go. For goodness sakes. All right, we've got a rough last question here, guys. I'm saving it up because, frankly, it's a tough one to get through. But this is a MoneyWatch user who calls herself Panicked. So nothing good is going to come after this. My husband and I took all of our money out of the stock market a year ago as we were seeing it drop. And the fees were also taking a lot. We had already lost $100,000. We put the money, the $400,000, in an IRA savings account, paying 3.75%. And there it sits because we are afraid to move it and lose more. This is all the money we have in the world. My husband is retired. He does not receive a pension. I am still working, but when I leave my job, I will not get a pension. I will have $21,000 in my 401k. I have about 3 more years to work before I retire. What do you suggest we do to make sure we don't run out of money after I retire? So let's just assume that by the time she retires, they have $450,000. What do you want to do?
I don't have a good answer for this. If you look at their need to take risk, they need to take some market risk and, do all the blah, 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 set an asset allocation, stick to it. But my hunch is that people that panicked in 2008 and early 2009, and missed the upswing, will do the exact same thing if they're back in the market. I think in order to take market risk, you've got to have both the need and the willingness to take risk. They may have the need, but not the willingness.
What do you think, Eric?
I don't think you can solve their problem with investing anyway, even if they were Warren Buffett. They need to work. She can't retire in 3 years. Their problem is the problem of an entire generation in one example. And like the baby boomers, we're going to have to figure out ways to stay in their careers longer to make up for their losses, and more important, for their lack of saving during their productive years. These people will too. And there are lots of good reasons to work in addition to the financial aspect. You're going to be more engaged, and you're going to feel you'll have more simulation in your life, and you'll feel more accomplished, and you'll feel more in control of yourself. And the arithmetic is they got to do it.
Yeah. And if they find themselves sort of at the end of the rope, Allan, and I'm making this up because I don't know this about them, but let's assume they own their house. How are you feeling about the reverse mortgage option as people get older?
Reverse mortgages are expensive, but
Yeah.
they're a heck of a lot better than the last generation where, the bank automatically got the house. But, I do believe that one should tap the equity in their house as a last resort and try to do it in a way that minimizes some very expensive fees.
Yeah, you just can't retire. I mean, that's number one. And number two, I think that there is a lesson here, and I agree that if you are completely freaked out about the market and you probably never should have been in to begin with, then that really puts a great deal of responsibility on you to do a lot more saving and live much more frugally because you don't get any upside.
I get people that come to me and they say, I didn't panic and sell. And then I look at their total situation and they have this huge tax loss carry forward. And where did the tax loss carry forward come from?
Yeah.
What they sold at the bottom of the market.
That's so funny. So you bust them, basically. You've yet to do that. That's good. You know what else I think is interesting is that a lot of one of the greatest benefits of having a diversified portfolio is that you're much less likely to panic at the bottom. You really are, because if you lost 50%, I get panic. That makes sense to me. But if you were down 22% and it was really freaky and scary, but you had your emergency reserve and you lived within your means, you're probably not going to have panicked quite as quickly. I mean, it doesn't mean you would have not have, but
less likely.
Less
certainly.
likely.
Well, there's also a psychological benefit that has nothing to do with the math that you just laid out. If you're diversified and you are properly diversified, there's always going to be something you can feel good about.
Right.
So
I like that.
Your emerging
I like
market
that.
stocks are tanking, but your treasury bonds are up, and you can say, wasn't I smart to put 20% in treasury bonds?
Exactly.
And not panic.
Exactly. So, gentlemen, another fabulous episode of Ask the Experts. Thank you very much. Allan Roth, go check out his blog on MoneyWatch.com. Eric Schoenberg, check out his blog on MoneyWatch.com and everything else.
Just check out MoneyWatch.com,
Exactly.
please.
In fact, Eric touches everything on MoneyWatch.com, so the entire site is his. So just check it out, will you please? Thank you so much for joining us. I'm Jill Schlesinger.
I'm Eric Schoenberg. Jill, you were terrific. Thank
You are both fabulous, and we are now going to go plot to figure out how we can blow up more variable annuities before the next episode. Tune in next week. Shoot us an email, asktheexperts@moneywatch.com. We'll see you then. Thanks a lot.